Joining me now to talk about what's ahead is Jay Woods. He's the Chief Global Strategist at Freedom Capital Markets. Good morning, Jay.
Hey, good morning. Great to be here.
All right, so we have a lot going on in the markets. Markets have been pretty resilient. Do you see this resiliency continuing into September and October?
I do, but I think as you nailed it in the opening, September is just a wonky month, and bad things tend to happen. It's the worst performing month. It's the only month of the 12 months that's down over the last 100 years on average. So we are not getting off to a great start. August did break a trend. That was the second worst month historically. So that was good, but we have little earnings to digest, lots of drama in D.C., and Fed that may cut rates with a few data points heading into their decision on the 17th. So I think volatility will be the story of September, and we're kicking it off. It's a Monday on a Tuesday, which is nice. It's shortened a week, so there are going to be a lot of headlines to digest between now, the Fed decision, and we're kicking it off with this tariffs. That's a big story hurting the market right now.
Why is September a historically low month for the stock market?
Yeah, there's something called the September effect. There are theories that people have into it, people readjusting their portfolios as they head into the fourth quarter, selling winners, looking for losers, and the Russell has rallied, so maybe there's credence to that. People selling down stocks to pay for college tuitions, that actually happened with me. So I don't know why historically it is the weakest month. And then October has this history of having the worst days occur in it, but it's also known for the most lows occur in October. So what I think is we're setting this up to have a rocky September. Let's put it in perspective. The S&P 500 is almost up 35%, 34.7% from its liberation low to its recent peak. During that run, we've had two corrections of 3.3%. We have not really seen the market pull back. We pulled back 3.3% from our recent high. We're at 6250, 6300. We're just at 6500, so it's not that big of a pullback. So any pullback right now, I think we'll see the resiliency of the consumer come back. I think retail will continue to buy these dips, and overall, the economy is going well with a few concerns hanging over it, especially on the tariff front.
And speaking of tariffs, the Federal Appeals Court ruled that some of Trump's tariffs were illegal. How is the market digesting this?
Yeah, well, we're seeing a spike in the 30-year right now. So the bond market's not really liking this because we may have to pay back some of the tariffs we've already taken in if they're deemed, what is the word? Illegal is not the word, but if they're deemed not to go forward with the tariffs. So this is a concern. It will go to the Supreme Court. So it's one of these, all right, we kick the can down the road, but there will be certainty on this tariff decision, hopefully by the end of this month. And that will, see what happens. Because when we have tariff uncertainty back in April, when they were raising them, it caused angst in the market. Now we have tariff uncertainty. We've already taken some in. We may have to give it back. And then the administration may look for a workaround to try to levy tariffs in a different way. So it's going to add a layer of confusion the market doesn't need right now.
It's even more uncertainty. And just with everything going on, how should investors be preparing for this?
Well, the long-term investor should be okay. Try to block out the noise, the drama that we continue to see in Washington. Because what is it? The S&P is up 10% this year after a very rocky 2.5-month stretch. And long-term earnings continue to grow. We're seeing earnings growth. Wage growth is still there. The consumer's still spending. There are some, clouds on the horizon. But overall, the long-term story seems to be intact with a few speed bumps along the way. The Fed will be the next major hurdle. If they cut, let's see what that does. We want to see that housing market come back to life. Housing stocks starting to pick up. They're making higher lows, turning around, breaking some downtrends. So there's some activity there. If we can get people, mortgage rates a little lower, people to start spending on those large ticket items like houses, then I think the leg of this bull market will continue to run. But right now it's still a technology story, and technology stocks have done well.
The jobs report comes out on Friday. What are you anticipating?
Well, we're anticipating it to come in at 4.3%, and that's a significant number. Why? Because we've been at 4.2% 6 different times. So, if you look at price action and all of a sudden something changes, that's a trend change, meaning unemployment is ticking up, which gives the Fed the right, the right to cut rates. But what is going on? Is this a bigger problem that we, haven't really addressed? So the Fed is going to be watching this closely. As you said, there's a 90% chance we cut, but then the week after that we get inflationary data. Inflation is starting to tick up in the CPI and the PPI. So the dual mandate that the Fed watches so closely, right now their eyes are back on unemployment, which says, okay, we're going to cut, but what about inflation? So it is a delicate balance right now, but I think that unemployment number, if it does come in line, which would be 4.3%, and then let's watch revisions. Revisions were the story last time. It could put a little bit of volatility back in this market. So I would buy volatility just to be safe, given the September backdrop to this market.
Thank you, Jay Woods, Chief Global Strategist at Freedom Capital Markets. Thanks for joining us.